Hey, what's up, everybody? I'm here with Jeremy from DividendStockpile.com. And yeah, he's community member. He's been around the block with us. We've been around the block with him. And before we get going, I highly recommend going to DividendStockpile.com, checking out his YouTube channel, because Jeremy, this is going to be what we're talking about. You've had a lot of covered call fund managers on your channel as of late. So it's kind of the new hotness, new thing that everyone's talking about. So I wanted to bring you on and just kind of talk to beginners and share what I know, share what you know, which is probably a lot more than I do. So, dude, thank you for coming on again.
Absolutely. Looking forward to our discussion for sure. Yeah, cover calls are great, but you have to know what you're getting into. So I'm happy to talk through these, show everyone kind of the differences and what to look out for.
So these are slides that Jeremy sent, and yeah, we'll go through them. This will be the flow of our discussion. And if you're listening on the podcast, which I hope you will tune into the YouTube video because it'll make a little bit more sense. So I guess just start us off real quick. Tell us about how they work with these covered call ETFs.
Yeah, sure thing. So there's been a lot of innovation in the ETF space over the last couple of years. There was a amended rule back in 2019 that allowed ETF companies to start doing derivative-based products, and that's what cover calls are, derivatives. And so you've seen a huge increase in the number of cover call ETFs coming out there. It seems like every month there's at least one or two more coming out with new features, new nuances, huge yields, little yields. It's all over the place. So it's really good to really get a background on what cover calls are all about and how these cover call ETFs work. And there's so many different variations, which we'll go through today. And basically, when a company opens up a cover call ETF, really what they're doing is they're taking over the process of writing cover calls for you. So you can do cover calls on your own, but it takes a lot of time, a lot of effort, and also a lot of understanding. So what these cover call ETFs do is they do the work for you. So what the fund company will do is basically they'll either buy or simulate ownership in some particular underlying stocks or ETFs. So you have things like they follow the SPY, the QQQs. You have some that just do a basket of stocks that the managers pick. There's all different types of underlying strategies. But once they do that, they utilize that ownership to write covered calls. And really what a covered call is a contract between the fund company and some third party to give the buyer of that contract the right, but not the obligation, to either buy the shares from the fund or settle in cash where the fund has to provide them cash. And so that's where all the premium comes from, is from those options contracts that they do. They can do daily, they can do weekly, they can do monthly. There's all different types of contracts they can pick from. And that's why it's really important to read through the disclosures of each ETF to know how they do their contracts. And they can pick the expiration date, how much above or below the current value of the stock or ETF they want to write the contract for. They do it all for you.
I like to joke around and say that there's people behind the scenes that are pushing buttons and pulling levers, and it is kind of complex, right? So that's why they do have a higher expense ratio. A lot of them are pushing that 1% expense ratio.
Some are even over 1% now. It's quite incredible. But there is a lot of work that goes into these ETFs. I'm not saying there's not. And as a professional, they should get paid for their services, just like a doctor or a lawyer or anything else. It's your money. You have to see if the fees that they're charging is worth what you're getting out of it. So just to finish up the slide, so as they write these contracts, they pick what details they're going to do, and they collect a premium. And that's cash to the ETF that then they use to pay out their shareholders, either weekly, monthly, or quarterly, however they do it. And so that's really how covered call ETFs work. It's pretty straightforward when you think about it. There's so many nuances of how the manager runs the fund that's where you get into a little bit of trouble understanding how they all work.
So that's the methodology of it. And as we always say, if you're new to this, that any ETF, even if it's VOO, which is a popular one, it's basically the S&P 500, pretty much the 500 largest publicly traded companies in the United States, you still have to understand the methodology of every ETF, how they work and how they're selecting and what they're weighting even. So there's a little bit to it, but you always have to look under the hood and understand.
And even though something like SPY or VOO is considered a passively managed fund, there's still a lot of changes that happen in those. So every quarter, the people who run those indexes decide if there's new stocks that are going to be added to the indexes, some that will be taken away. There's a lot of changes. The weighting of each individual stock. So to Russ's point, even if it's something very basic like VOO, SPY, still make sure you understand how they operate.
Yeah, and market cap and weighted cap. I mean, that's a simple thing some people miss. And that's why the joke around, our circles is that when you buy VOO or VTI, which VOO is the S&P 500, VTI is pretty much every publicly traded company in the US stock market, is that it's a tech ETF because you got the Mag 7 that are just disproportionately at the top. But if you don't like that, then you go with a market weighted, and every company gets the exact same allocation inside the fund. So again, just something as simple as that. You really have to understand what you're buying. All right, so the pros of owning these covered call ETFs. Walk us through some of the good things about them, Jeremy.
So the number one pro of owning a covered call ETFs is the passive income. Like we talked about earlier, there's a lot that goes into these covered call ETFs. You have to pick the strategy, you have to do the calls, you have to pay out the money, things like that. For us as investors, it's passive income. We don't have to do anything besides click that buy button. And so that's definitely one benefit of letting a fund company do your covered calls as opposed to you trying to do them yourself, is because you just sit back and let them do it. To that point, it isn't professionally managed. These are people who are licensed. This is what they do all day. They have the knowledge, they have the understanding, they have the licenses, they have everything in place to do these. So while it's not going to guarantee any kind of result, they do have the background and the knowledge of how to do these. And one of the great things about covered call ETFs is the income is great. Let's just say you do a CHD. It's paying around 4% a year right now in dividends. Covered call ETFs, you can have anything between 4 and 125% distributions. So the income is really great on the covered call ETFs. But again, there's always a trade-off, and you have to understand what you're buying. And then the next great thing about covered call ETFs is it can give you cash flow in almost any kind of market, whether the market is flat, up, slightly down. You can still receive that monthly or quarterly income, where if you just were investing for capital appreciation, there'll be some times where the market doesn't go up. And if you're doing like something like the 4% rule, taking your money out, is going to be really hard. But with the cash flow that these covered call ETFs provide, you can get income no matter what's going on in the market.
Yeah, so we're going to get into the income. Don't worry. I got a lot to say about that. We'll put a pin in that. Yeah, I mean, it's just like you said, and I think a lot of retail investors are attracted to the high income we see. Now, one thing, I go on StockTwits sometimes. I don't know if, do you ever go on StockTwits?
No, I try to avoid it.
Yeah, it's a little bit of a juvenile cesspool, but I don't know why I do that. That's I guess that's my guilty pleasure. And when I go on these covered call ETF funds, sometimes like TSLY or MSTY, which they follow a reference asset. TSLY is Tesla, and MSTY is MicroStrategy. And everybody says the dividends, they're paying a dividend. The dividend I got, dividend this. And actually, it's a distribution that they're paying because there is a high return of capital. Maybe I'm getting a little bit ahead of myself, but we'll just go right into it with some of the cons, because I think there's quite a few. And I think people should understand them before they really invest in some of these. So return of capital when you're getting your own money back is what I don't like. We also call that destructive return of capital, and the net asset value of the fund will usually decrease as they're paying out kind of like the roof tile. Like if you have a house, that would be like selling the roof tiles to buy groceries. Like you don't want that. You want to be adding to the house and building onto it, not like deconstructing it. So I think some of the downsides, and see if you agree with me on this, I think they have capped upside potential, meaning that tell us about when you write a covered call. Just on its face, anytime you write a covered call, why does it have capped upside?
When you write a covered call, you're basically trading capital appreciation for current income. So the way covered call works is you have a underlying stock. Let's just keep it easy and say you have Apple. You have 100 shares of Apple, and you're willing to sell a covered call. Basically, you're giving someone else the right, but not the obligation to buy those 100 shares of Apple from you at a certain price by a certain date. And that certain price is what is called the strike price, and that's what limits your upside. So I don't know what Apple's at today, but let's just say you want to do, it's at 200 and you want to write a call at 210. Well, if Apple has great earnings next month and it goes up to 250, because you wrote that covered call at 210, that's the max you can get. So you're going to get your premium up front for doing it. That's the cash you're exchanging for the potential upside. But then if no matter what Apple does, beyond 210, you don't get any more value. So that's one of the downsides, and that's what we call the capped upside potential. Again, you're limiting your upside, but you still do have all the downside. You still own those Apple shares. So if Apple tanks, or if you have Tesla and Elon Musk says something and it goes down 20% like it has in the last couple of days, you're still stuck with the downside, but you're capping your upside. And that's the same for any covered call, not just the covered call ETFs.
Kind of one of the things to think about, that these ETFs, that they seem to work best in sideways markets. So in a raging bull market, it's kind of tough because they're capping their upside for the fund. And I think that bleeds into the high return of capital. And this is something that can be confusing. I'm still learning about it in some ways, so correct me if I'm wrong. But when they're supposed to be generating income to pay out to the shareholders through the distributions, when they sell these covered calls and they make their option income, sometimes it's not enough to hit that high yield target. So to fill in the gap and the difference, they give some of investors' own money right back out of the fund, which is destructive. It drops the net asset value of the fund. And when that happens, I've seen a lot of them. I've looked at TSLY, MSTY, most of these, even some of the newer ones like GPIQ. I know it sounds like an alphabet soup here, and it is 90% return of capital at some times on these. JEPI, I think, is one that was a little bit lower. When you see that 90%, it's literally like 90% of your own money coming back to you, and 10% is the net income. This might be going a little too far, but you can look at the 19A1 notices. That's one way to tell how much of your own money you're getting back. So is that kind of right? And what are some of your thoughts on the return of capital?
Yeah, so there's a lot of confusion out there, and probably the reason for it is there's two different types of return of capital. The first one is destructive return of capital, which is exactly what you said, where they wanted a certain yield and they weren't able to accomplish that. So instead of using the premiums that they get from the calls to pay your distribution, they're taking a little bit of the principal and giving it back to you to hit that distribution rate. That's not as common on these covered call ETFs as opposed to this next one, which is called constructive return of capital. So return of capital, it sounds like they're returning your money, but in this particular instance, what it is just a tax implication. So as these companies are writing these covered calls on a monthly basis or a quarterly basis, whatever they end up doing, sometimes it goes in their favor and sometimes it goes against them. And so at the end of each month, they have to make a tax calculation of their profit and loss, just like you would for any kind of business. So if they have more gains than they have losses, then that is just like us gaining on a stock. Over time, we have to pay taxes on it. But what ETFs can do, and this is specific to ETFs, is they can roll their losses forward to offset some of those gains. So if they do that offsetting the capital gains later on, that allows them to call this distribution a return of capital, ROC. So that's a constructive one where you're reducing your tax basis based on that tax status that the IRS gives you. And so for these covered call ETFs, especially the ones that are like 90-95% return of capital, it's not necessarily that they're always giving you the money back, which it could happen. You need to look into that. But a lot of times it's just the IRS classification of the distributions because they can do that tax loss harvesting.
Well, tell me, am I wrong? Is the difference though that you want income, so they can give you income, right? Which are actual profits. And that is the constructive return of capital. It lowers your cost basis. You don't pay taxes on that, I understand, until you sell. But if your cost basis does hit zero, then any distributions received after that, you have to pay your ordinary income tax on. That's from my research, what I think is accurate. What are some of the red flags? What are a warning sign? What are the ways that we could tell if they are returning our own money back to us and it is a destructive return of capital?
It's really hard to tell. And that's the unfortunate part, is because even like you said, every month they're supposed to list out that 19A disclosure with their estimated return of capital and regular income and things like that. You really won't know until the end of the year, where they give you an estimate, but there's no certainty until after they do their entire tax filing. And the reason for that is because that tax loss harvesting I was talking about. There's sometimes where in the middle of the year, it looks like they're going to have to pay out a lot of taxable income. But then second half of the year, they take a lot of losses and it offsets. And then when you get your final notice, there's little tax implications. But going back to your question about once you get to a cost basis of zero, it really depends on how long you've owned the fund. So if you've owned the fund for less than a year and you're back to a cost basis of zero, meaning they paid out so much money that you've recouped all your money, then yeah, that would be considered short-term gains. But if it is over a year that you've held it, it becomes long-term gains for anything past your cost basis. So that's not so bad because most funds, it's going to take more than a year to make your money back. And so if you do get to zero, then you're going to have that long-term capital gains instead.
Next, we're going to roll right into the categories of the covered call ETFs. So just give us a little bit of a primer on those.
Yeah, absolutely. As I said, back in 2019, when the rules changed of what types of strategies that people can have in these ETFs, there's so many different varieties of covered calls. So not all covered calls are created equal. There's actually a lot of difference between them. So for those who have seen the super high yielding ones, those are certain type of ETF. But there's other ones that are much more balanced and actually very conservative. So there's a bunch of different ways. So you have to really understand what each one does. So I'm just going to run through these. Tactical covered calls is basically an active manager is picking individual stocks or a small percentage of the underlying holdings to write calls on. So they're not doing 100% of the underlying value in covered calls. They're not capping your upside on the entire portfolio. Sometimes they could pick 5, 10, 15% of the portfolio to write calls on, just get a small percentage in options premium, but then you have all the upside of the remaining assets. So this is very tactical. They pick individual stocks and they do not write on the whole portfolio. Those are your most conservative ones. Those are the ones that are going to end up having the best net asset value gain over time because they don't write on the entire portfolio.
And we'll give you guys examples of these in the next one, but he's going to run through them first. So.
Absolutely. ELNs, this is mostly used by the JP Morgan products like JEPI and JEPQ. But what it is instead of writing covered calls, it's a covered call-like strategy. And so they are actually signing up a contract with another party to basically do an investment or like an insurance product where they're guaranteed a certain amount of income for signing up for that contract. It's like a covered call, but it provides income to the fund, but it's not a true covered call.
Is it kind of like a bond then that's tied to a stock?
It could be a bond. It could be an options contract. It could be a mix where it says we're going to guarantee X amount minimum, but then anything over that, you guys gain extra money. There's a lot of different ways they can do it, but it's an active manager, and they usually only do it on a very small percentage of the net asset value of the fund. We're talking like 15 or 20%. And then the rest of the fund is available for the capital appreciation, which helps when it comes to the NAV erosion that we've been talking about earlier. I think one of the most common ones now is this next one, is synthetic or rules-based. Even though these are active ETFs, there's not like the manager is sitting there pushing buttons every single day, making the calls and things like that. What this is they set up a rules-based system before they start the ETF, and the manager just follows those rules. So at the end of the month, when they're deciding which covered calls to write, they're basically looking at a formula, and it says, okay, the market volatility is X, the stock prices are at Y, here's how much we're going to do, here's which ones we're going to do. It's all rules-based, and the manager just follows the rules. So that one is kind of medium risk. It's kind of in the middle, where you're going to get some good income, but you're not going to have the NAV erosion where all the funds are being paid out in distributions. Then you move over to the 100% ATM. That means at the money, meaning they're writing a call right at the strike price or right at the price of the underlying. So let's just say the QQQ is at 300 today, which I know it's not, but let's just say it. When they write their covered calls, they're going to write it at a $300 strike price, meaning there's no upside. They're going to gain a ton of income because the risk of the buyer being able to exercise that and make money is high, so the buyer's willing to pay a lot. So these are the ones where they're going to, every month, whatever happens, they're going to write their entire portfolio or very close to the entire portfolio at whatever price the market is as of that time. They're going to gain a lot of income, which is going to be paid out to you, but there's no upside. And so that's what really gets into trouble when it comes to this NAV erosion. Let's just say that they write it on the Qs at 300 this month, but the Qs has a hard month and it's down to 250 next month. When they're done with these contracts, they start over at that 250 and write 100% of that at 250. So you're basically locking in your profit. And so every month that the market goes down, they're going to be writing those calls at that lower and lower and lower strike price. And that's why you see a lot of these funds losing the capital appreciation, and the dollar amount of the fund goes down because they're having to rewrite and basically lock in their losses as they write that 100% of the money. And then the last one, and this one gets really complex, is called synthetic cover calls. So in these, they don't actually own the underlying. They don't own the stocks. They don't own the Qs or anything like that. They buy a call to simulate that ownership, and then they sell a call for income. So it's called a synthetic cover call. And again, this is how the yield max funds work. Appley, Tesla, whatever. They buy a call on Apple, and then they sell a call on Apple. And so that's how they generate the income. And because they can do that, and they're basically using leverage, their returns can be ridiculous when it comes to distributions. That's where we get the 100% returns, 50% returns, things like that. They don't own the underlying, so you're not actually profiting from the company, you're just profiting from the volatility of them writing those options. And they can do that on individual holdings like Apple, Tesla, MicroStrategy one, or they can do it on an entire index or like ETF. And so that's really the 5 different ways. So again, not all covered calls are the same. You just have to know which one that you're dealing with.
So here's some examples of these covered call ETFs. I had owned DIVO for a hot minute. Do you own any of these? And why don't you go over a few of these?
I actually own quite a few of these. So full disclosure, this is not financial advice, but I own DIVO, IDVO, WHEEL, JEPQ, SPY, QQI, and a bunch more, but they are not listed on here. This is not all inclusive. So I'm a big fan of covered call ETFs, but I have about 20% of my portfolio in these covered call ETFs. It's not 100% of my portfolio because I want that capital appreciation. But things like DIVO is where they only do a very small percentage of their calls on their underlying. They might pick 5 or 6 stocks every month to write a little bit of call on, just get a little bit of income. But then the rest is just available for capital appreciation. Something like JEPI and JEPQ are the ones that write those ELN contracts, which is cover call like. They're going to get a little bit of income from that, and then they're also going to have the capital appreciation and the dividends from the underlying holdings. SPYI and QQQI are some examples of those systematic ones. You also have GPIQ and GPIX in that category, where there's a rule set up that the managers follow. They can do anything between 25% and 100% of the underlying equities and calls, but the manager decides based on the rules that are in place. Those 100% at the money, those are the QYLDs, XYLDs, RYLDs, all those. They basically rewrite the calls every single month at whatever the market price is, up or down. So you don't have any upside on that one. And then the synthetics, like we mentioned earlier, those are all the yield max ones where they buy a call to represent ownership, and then they sell call to make the income. So XDTE, which is a 0-day cover calls, which I think is a little crazy. And then you have the yield max, which is a monthly cover call. So again, there's so many different products out there. Just have to find the one that fits your risk profile.
And as I look at it, going from tactical is less risky. If I remember right from DIVO, they actually they own all the stocks that they write the covered call contracts on. Is that right?
Yep. Yeah, you're right. So DVO and IDVO usually hold between 35 and 50 different companies, like individual companies, and then they'll pick which ones they're writing a call on. So let's just say they own, I don't know, Apple and Johnson & Johnson. One month they see that Apple may not have a lot of capital appreciation or something's coming up, so they're going to write a call on that one to gain a little bit of income. But they're not going to write it on Johnson & Johnson because maybe the premium's not high enough or it's not worthwhile or whatever. So they're very selective on which ones they choose. And because they're very selective, your yield is going to be a lot lower because they're just picking and choosing a few to get a couple extra percentage points a year.
And it still kind of reminds me of that saying holding true, like the higher the yield, the higher the risk, the lower the yield, the lower the risk. And that's Absolutely. The way that these kind of feel. So,
yep. And if you look at the total returns of each one of these, you'll see how the risk plays out. You're not going to have very much income on the lower tactical ones, but you're going to get more capital appreciation. And this is just my basic opinion on the risk level of each of these. I think you guys kind of felt that on the way I was talking about it. Tactical is lower risk because there's not as many calls being written. Synthetic is very high because they don't actually own the underlying. They're just doing options contracts to simulate it.
And to prove this out, so of all those that were listed right here in this slide, I went through and I just did a total return test. This is actually with dividends or distributions, both reinvested. I went to the inception date. Now, I want to preface this because I know some people watching are going to say, we're not buying these to beat the S&P 500. But in my mind, I think a lot of younger investors should be looking at building long-term wealth. And just comes to mind the fact that most of these ETFs, if not all of them, they underperformed in 2021, 2023, 2024, the broader market, but they outperformed in 2022 when we had a bear market. Mm-hmm. So I think you almost have to get the full benefit of them, it would seem, and I don't know if you agree with this, that you would need to time the market to buy them in a sideways market, or when the market is going down is when they seem to work. They seem to work better.
Yeah, they definitely work better because you're getting that income every month or every quarter, and it doesn't matter what the stock prices are doing. So that basically gives you a little bit of a bounce or a little bit of a buoyancy in the stock or in the ETF because you're getting that call income, and income's always positive even if the market's negative. So that's why it can outperform. But yeah, in a raging bull market, none of these strategies are going to beat the S&P 500 or the QQQs. That's just not how they're built. Again, going back to we're trading capital appreciation potential for current income. And if you're a younger investor or an investor who doesn't need the money right now, why do you care if you're getting 100% on an Appley? You're not growing your wealth. But if you were to do the same thing in the QQQs or something like that, you're going to take full advantage of the upside of the market. So you really have to think about where you sit as an investor and what's most important to you.
You can see the chart on the screen. If not, I compared them all, and actually only 2 of them outperformed since their inception. I don't know. I just think that's an easy number to pick. When they started trading, if you were to do a buy and hold and reinvest all your distributions, only 2 of them, which was IDVO, oddly enough, outperformed by 1%. So that's barely anything. But they were incepted in, I think that's a word, September 8th of 2022. And then YMAX, which is that all the yield max funds together, or is that just or just the yield max as the,
Yeah,
how does
so
that one work?
it's a fund of funds. So I
Ah,
think if I remember correctly, they hold like 5 or 6 or 7 of the yield max products inside this one ETF. Yeah,
okay. And that one outperformed by, oddly enough, 1% since
but
it came
we're
about
only talking about a
January.
little over a year though, so it's hard to know what's going to happen in the long run.
Yeah, and I'm super interested. I plan on being around in 10 years from now to see which of these are around, which ones have outperformed, underperformed. But speaking of a long time frame, the granddaddies are QYLD and XYLD. So XYLD was the very first covered call ETF in June 21st, 2013, and that's on the S&P 500 is the index that it's referenced, and then QYLD is the Qs on December 11th, 2013. But shockingly, over the long term, if you were to have bought and hold those to this day and reinvested all the distributions, you would have underperformed on XYLD. You would have underperformed the S&P 500 by 241%, and QYLD underperformed by 195% underperformed. So
Hmm.
I think it just reinforces, and again, we don't know what's going to happen in the future, but I don't think these are very good long-term buy and hold, set it and forget it and turn drip on.
Yep, unless you are focused 100% on current income.
Good
And
point. Good
that's
point.
really what it comes down to, is if you need the money now, because with something like the XYLD and whatever, you're going to be getting that 10, 12, 15% paid out annually as income. So if that's a priority for you and you're not really worried about capital appreciation, these could work for you. But if you still have 20 years, 30 years, 40 years until you're retiring or need the money, in the long run, these are never going to beat the market unless we have a prolonged downturn like we had back in like the 2000s or something like that.
Now, if somebody was, we'll wrap it up here and land the plane, but if somebody was a younger investor and they were like, yeah, I don't care, I want to get all this high income, what do you think would be a sensible portfolio allocation? Again, not financial advice, just Jeremy's opinion. What
Yeah,
do you think
definitely.
would be a sensible allocation of one's portfolio to these funds?
Yeah. So again, not professional advice. I'm not a professional advisor. My philosophy is no more than 5% in any one of these strategies. So yes, you can have a few of these like I do. I have DIVO and IDVO and JEPQ and SBYI, but none of them are more than 5% of my portfolio. And in my entire portfolio, I'm at 20% allocation to these. So that remaining 80% is things like the Qs, things like the S&P 500, individual dividend stocks, SCHD, things like that. So I'm still 80% or more of my money is for long-term growth and capital appreciation, and then a little bit is for the income. Some of these I reinvest in the same fund, and some I just use that cash to buy more dividends on something else that can grow more over time. You have to know what your risk tolerance is. You have to know what your timeline is. I'm in my early to mid 40s. I
Me
still
too.
have 15 years or so before I could even think about using a lot of this money. So for me, it's kind of a balance between getting some income now, but mostly capital appreciation over the long run.
Yeah, I agree. And for myself, I've talked about my shift to 85% of my portfolio into funds like VOO or in VTI and SCHD, and then 15% in individual stocks. But yeah, I think it can be fun. People should have that play account, have 5%, 10% of a portfolio to do YOLO stuff if you want, and do things like that. Again, just our opinions. But for me,
Yep.
I think a traditional low cost, broad based index fund, and then you can use some selective dividend focused funds like VYM or SCHD to boost that income. But dude, I thank you for this, and I think that hopefully we shed some light on giving people, honestly, from what I see from a lot of people's comments, I think these are a little bit maybe overhyped and misunderstood by
Yep.
most retail investors. So if you've made it this far, I love you for it, and we love you and hope you give it a thumbs up. And Jeremy, once again, dividendstockpile.com and his YouTube channel. You got to check it out. He's interviewing a lot of the fund managers. So real quick before I let you go, what is one thing you've learned from talking to all these fund managers? Is there any bit of wisdom, piece of advice, and anything parting thoughts you want to leave with us?
Yeah, so it definitely all comes down to your timeline and your expectations. But what I found when talking to a lot of these fund managers is don't put all your eggs in one basket, even if it's a great cover call ETF. One that I met with a couple weeks ago, he basically said, don't forget small caps, don't forget international stocks, don't forget just traditional S&P 500. Like you can have a dividend focus or an income focus, but don't forget about these other pieces of the puzzle, because large cap growth has not always been the best performer. Small caps over time is unreal. Remember REITs, remember international, just keep it diversified, because you never know what the next 10 years is going to look like, much less the next 30 or 40 years until you need the money.
And I would add that if this all sounded really confusing to you, it's because it is. It's complex. And to a beginner, this is going to be really confusing. So, again, if it's too complex, keep the percentages really low while you learn and you foray into this. So, Jeremy, once again, man, thank you so very much for doing this. And we really appreciate you.
Absolutely. Always a pleasure to come on. Love talking about it. Definitely let me know in the comments if you have any questions. I'll try my best to answer anything.
You guys be good, and we'll see you next time.